In this video, I'm going to talk about the 5 things that stop a lot of first-time home buyers, and I'm going to give you some tips on how you can get around some of these issues. You want to find out what they are? Well, stay tuned because we're getting into it right now. Hey everybody, Dietric Williams, realtor with Compass here in Baldwin Hills, California, and welcome back to Info on the Go, the show where I give tips, tricks, and insight on how to buy, sell, or invest in real estate in Southern California. If that's something that you're interested in, please make sure you hit that subscribe button and ring that bell so that you are notified when I upload new content onto YouTube. Now, my team and I, we're getting calls from all over the place from people who just want to know what it's like to live, eat, and play in Southern California. So if you're thinking about making a move to Southern California, please give us a call, shoot us a text, send us an email. However you want to get in contact with us, just know that we got your back with everything that's Southern California. Now, one of the main things that I see facing first-time home buyers is the issue with having enough money for the down payment. And it's no doubt that the coronavirus pandemic has had a major impact on people's financial affairs. Many first-time home buyers were forced to dig into their savings. Some got furloughed, some lost jobs, and that just really caused a damper on their plans. Now, there have been stimulus checks that have gone out that have served as kind of a stopgap to some of these things. So it's allowed some people to just be able to maintain or take care of some random bills, and others have been able to stockpile. Now, if you were one of those people who had to use your stimulus payments for something else and you had plans to purchase a home, I want you to stay encouraged. It doesn't mean that you're not going to be able to purchase a home. It just means that we may have to be creative with how we come about getting some money for down payment. And there are a lot of ways for you to do this. And one of the biggest misnomers is that you need to have 20% down in order to purchase a home. And that's simply just not true. With an FHA loan, you can go as little as 3.5% down. And depending on where you live and the housing prices, that can mean the difference between several $1,000s or tens of thousands of dollars. And it's tax time. So if you're planning on getting a refund, think about putting that money to the side in order to help save for your down payment. Now, another way you can come up with the funds for a down payment is by getting a gift from your parents. Now, there are limits to this, so you can get a gift from each parent of $15,000. That's the max that they can give. So if you're single, you can get $15,000 for mom, $15,000 for dad, for a total of $30,000. If you're married, you can get $15,000 from each parent of each spouse. So $15,000 from mom and dad for one spouse, $15,000 from mom and dad for the other spouse. Collectively, put those together, $30,000, that's $60,000 that you can get gifted to you from your parents. The lender is going to require you to fill out a form that stipulates that this money is a gift and not a loan, because they want to make sure that you don't have to pay that money back. Another way to come up with the funds for a down payment is to tap into your retirement account. Now, you can't do this with a IRA, but you can do this with a 401k plan. Now, there are some stipulations to the plan, and you have to be very careful about how you do it, because you're borrowing from your retirement account and you have to pay that money back. And I get into more of that in this video right up here, so check that out. Another thing that's stopping a lot of first-time home buyers is having a lackluster credit score. Now, again, we're in the pandemic and many people were forced to dig into not only their savings, but also to tap into their credit cards. And this kind of caused a wave of things to start happening. For one, some people were late with payments, some people missed payments, and those things have a negative effect on your credit. Now, with lending standards being tightened due to the pandemic, it has become a little bit more difficult for some people to get qualified. For instance, the score that you had prior to the pandemic, your FICO score, could have gotten you a certain loan. Well, now those limits have increased on certain loans, so it's become a little bit more stringent in terms of the requirements. However, you got to remember that not all scores are created equal. So just because you have a bad score doesn't necessarily mean that you're going to be exempt from being able to purchase a house. One of the programs that you can take advantage of, I mentioned earlier, which is the FHA program. Typically, you need a minimum score of 580 in order to qualify for an FHA loan that will get you 3.5% down. If your score is lower than 580, they require a whopping 10% down. Not only that, but the lower your score, the higher interest rate is probably going to be. Now, if your credit score is on the fringes, there are a few ways that you can help boost this. One of the methods that I'm a proponent of is using the snowball method, and that's how you pay down some of your debt over time. Paying down that debt is going to help increase your credit scores. Another way that you can do this is to ask your lender to increase your credit limit. Now, what this does is lowers your credit utilization rate, and those two things that I just mentioned in terms of paying down debt and your credit utilization rate are huge factors in the scoring system. So I won't get deep into the weeds on that one, but just know that you can check the video out in the description below. Now, number 3 is the current amount of debt, and this ties into my last point about using credit to survive. But let's take it a step further and talk about the student loan debt that is crippling a lot of first-time home buyers. Currently, student loans that are backed by the government are in forbearance. Now, that forbearance was supposed to end on January 1st of 2021, but it's been extended through September 30th of 2021. Unless it gets extended one more time. Now, when forbearance ends, automatic payments will resume and interest rates will return. And this has hampered many people's plans of home ownership as they are unsure whether they're going to be able to meet the financial obligations when student loans return. Now, if you're unsure of whether you're going to be able to meet those obligations, please make sure that you call your loan servicer as soon as possible. So as we're talking about debt, all of this affects what's called the DTI, or the debt to income ratio. And essentially it just measures how much debt a person has relative to how much income they have. Lenders typically like to see that ratio hover somewhere between 36 and 43%, but only 28% of that number can be toward the mortgage payment. So there's really only one way that you can get around this. That's actually to just pay down the debt. If you were fortunate enough to save most of the stimulus money you receive, consider paying down a large portion, if not all of the debt that you've accumulated. This can have multiple effects on your credit utilization, on your DTI ratio, and also help to improve your credit score. And speaking of debt, I would be immensely indebted to you if you would do me a huge favor. Hit that like button, because it lets YouTube know that you're enjoying watching this content, and hopefully it pushes it out to other people who enjoy the content. So thank you in advance for hitting that like button. The fourth thing that's challenging a lot of first-time home buyers is the lack of unavailable homes within their price point and also within the neighborhoods that they're searching for. Now, you've undoubtedly heard this said time and time and time again. There is a lot of demand, but there's a little supply. In Economics 101, you know that when supply is high and demand is low, then prices tend to go down. But we're in the inverse, where demand is high and supply is extremely low. So it's pushing prices upward. And here in Los Angeles, prices have increased year over year by 10%, and they're expected to increase by 11% next year. Bidding wars are all too commonplace right now. Buyers are doing some very unconventional things, such as waiving their appraisal contingencies and or their home inspections. And this is placing some upward pressure on the market. In fact, it's causing home prices to rise artificially, sometimes between $50,000 and $100,000 above what the list price was. Now, in an area like Los Angeles, if you combine this with the decrease in available inventory that we've seen versus last year, I believe we're down about 18%, you can see where it can get a little bit shaky for a lot of first-time home buyers. There's a bright spot though. New listings are up 4% versus the same time last year. And I expect to see that trend continue to happen as the economy begins to open back up and more home sellers become more comfortable with the way that COVID cases are being managed. So previously, in the midst of the pandemic, it kind of scared a lot of sellers from jumping into the market. That decreased the inventory we would have had. So I'm expecting inventory to open up just a little bit as we continue into this year and things open up a little bit more. Here's the thing though, with people being able to work from home now, we're seeing migration out to the suburbs, those outskirts where prices are a little bit more affordable. So if that's you, you may have to compromise on where you live. And I'm not saying that you just live anywhere, but if you're able to work from home and you don't have to be close to your job, this is an opportunity for you to go out to the fringes to get a home that's more affordable. Now, again, I say this only if you have the ability to work from home and you don't mind living a little bit further out, because I tell my clients all the time, fall in love with the neighborhood, not the house. You can change the house over the course of time because you can reconfigure rooms, you can spruce it up, you can paint, you can do all these type of things, but you can't really change the neighborhood. I can't pick that house up and put it in a better community for you. And the fifth thing that is challenging a lot of first-time home buyers right now is little or no income. Yep, I know the pandemic has just hit a lot of people, and it's caused some people in their households to either operate on one income, little income, or no income at all. Now, if you don't have any income, there's not much that you can do in the way of going out to purchase a house. If you're operating on a tighter budget, there may be some help out there for you in the form of programs that offer little or no down payment assistance, little or no closing cost assistance, and maybe no mortgage insurance as well. All of that is a way to help you get into a home to save you money. So there are programs that are out there. You just have to be willing to look, and sometimes you have to be really patient. If you're in LA, there are programs such as CalHAFA, the Chenoa program, the LIPA and MIPA programs, which offer assistance for people who are low income or moderate income, or there is a national program called NACA. I'll put the link to those programs in the description below, or you can watch the video where I talk to one of my preferred lenders who goes in depth about a lot of these programs that are available. Now, another hack for purchasing a house with little or no income is to have somebody come on as a co-borrower, like a parent or a grandparent. Now, obviously, this person has to have their ducks in a row with good credit and the financial resources to be able to do it, but it allows you the opportunity to qualify for a mortgage. Furthermore, it could get you better rates and terms when you're talking to your lender by using a co-borrower who is strong financially. Now, keep in mind, your co-borrower is also going to be responsible for the payments, and they're also going to be listed as a joint tenant on the title, which means if you don't pay, it's also going to affect them and they can be on the hook for that. So be very careful if you're planning on being a co-borrower or having somebody sign on as a co-borrower for you. Now, as much as people want to say that all real estate agents want to do is just sell you a home, I'm here to tell you that's not how I roll. I've had clients before, they weren't ready. We've had to take a step back and work on these 5 things, sometimes anywhere between 6 to 12, maybe 18 months, regroup and come back at it. That's perfectly okay. And if you're in that situation, don't feel like you have to rush just because interest rates are low or they're rising right now and you want to take advantage of it. If you're not ready, you're not ready, and that's okay. Don't let anybody pressure you into buying something that you don't want. My goal to my clients is to make sure that they not only get the house, but they place themselves in a position where they are not going to lose it as well, because I don't want to have any of my clients have a foreclosure. That's just not something that I want to see on my watch. So guys, make sure that you be smart, that you be safe, and most importantly, be informed.